August 2022, European gas prices explode to all-time highs, factories go dark, and governments scramble to contain backlash. Beneath the headlines, these shocks reveal fragile fault lines others ignore. If Europe can unravel this quickly, what stops the same cracks from spreading worldwide? To see how historic mistakes threaten to repeat, let's trace where the first domino fell. Before war returned to Europe, the continent relied on a single supplier for nearly 40% of its natural gas. Russian pipelines stretched from Siberia to the heart of Germany and Italy, feeding homes, factories, and power grids. This dependence ran deeper than most realized. When those flows slowed and then stopped, the consequences were immediate and severe. By late August 2022, the Dutch TTF gas benchmark surged past €340 per megawatt-hour, shattering all previous records and sending shockwaves through global markets. Energy bills for households and businesses soared overnight. Governments scrambled to secure emergency supplies. But alternatives, mainly liquefied natural gas shipped from across the Atlantic, came at a steep premium. Maps of Europe's pre-war gas flows reveal a continent deeply exposed. Germany, Italy, Austria, and much of Central Europe leaned heavily on Russian imports, while only a handful of coastal states had enough LNG terminals to pivot quickly. As prices climbed, the risk was not just higher utility bills. For many, the fear was that entire sectors of industry could be priced out overnight. The energy squeeze was not a distant threat. It was a daily reality, measured in shuttered production lines and rising anxiety over the next winter. The underlying vulnerability, decades of concentrated supply, now stood exposed for all to see. Across Europe, governments raced to cushion the blow as energy prices spiraled beyond anything seen in decades. Emergency fiscal packages poured in, over €650 billion allocated by EU countries in less than 2 years. Germany alone committed around €158 billion, hoping to shield both families and businesses from the worst of the shock. Storage mandates became law almost overnight, requiring gas reserves to reach 80% capacity before winter, and then 90% the following year. But even as politicians promised security, the real pain landed on factory floors. In a small industrial town outside Frankfurt, a mid-sized chemical plant once ran day and night, supplying materials for everything from car parts to pharmaceuticals. By the autumn of 2022, the numbers no longer added up. With gas prices peaking above €340 per megawatt-hour, management faced an impossible choice: keep production running at a loss, or shut down lines and risk layoffs. The decision came quietly. Shifts were cut, investment plans shelved, and sections of the plant idled for the first time in decades. Workers, some with decades of service, found themselves waiting for updates that never seemed to bring good news. This story played out across Germany and beyond. Steel, fertilizer, and glass producers all scaled back, citing soaring input costs and the uncertainty of future supplies. Each curtailment rippled outward, affecting suppliers, local economies, and the broader industrial base that had long powered Europe's growth. The immediate response bought time, but it could not erase the fundamental strain now running through the continent's economic core. On July 21, 2022, the European Central Bank, the ECB, raised its key interest rate for the first time in over a decade, ending an era of negative rates and sending a clear signal to markets. The fight against inflation would take priority. Within hours, investors reacted. The cost of government borrowing in countries like Italy and Greece shot up, while German yields rose far less. This difference, known as the bond yield spread, became the new barometer of stress across the euro area. On that day, the gap between Italian and German 10-year bonds widened sharply, echoing patterns last seen during the Eurozone crisis a decade earlier. Bond yield spreads measure how much more investors demand to lend to countries seen as riskier. For Italy, with public debt hovering near 140% of GDP, even a small increase in rates means billions more in annual interest payments. Investors track these spreads closely because they reveal underlying doubts about a country's ability to manage its debt without outside help. When the ECB raises rates, the pressure on weaker economies grows, and the spreads respond immediately. Charts from the summer of 2022 show Italian yields jumping above 3.5%, while German bonds stayed below 1.5%, pushing the spread past 200 basis points. This was not just a technical shift. Higher spreads make it more expensive for governments to borrow, and for banks who hold large amounts of their own country's bonds, this can erode balance sheets and tighten lending. The ECB's move was meant to cool inflation, but it also exposed old cracks in Europe's financial architecture. As spreads widened, policymakers in Frankfurt and Rome watched nervously, well aware that a return to the debt bank spiral of the early 2010s could threaten the entire project. The bond market had delivered its verdict, and the message was unmistakable. Monetary tightening in a divided currency union always carries risks that go far beyond the central bank's meeting room. Italy's public debt now stands at nearly 140% of gross domestic product, one of the highest ratios in the developed world. This burden is not just a number on a spreadsheet. It shapes how the entire financial system works. Italian banks, along with their counterparts in Spain, Portugal, and Greece, hold large volumes of their own government's bonds. According to data from the European Central Bank, in several high-debt countries, these holdings amount to around 10 to 15% of total bank assets. When government borrowing costs rise, as they did after the European Central Bank's rate hikes in 2022, the value of those bonds falls. For banks, this means weaker balance sheets and less appetite to lend to businesses or households. The connection runs both ways. Governments need buyers for their debt, especially as deficits persist and refinancing needs climb. S&P. Global estimates European governments will borrow roughly 1.8 trillion euros this year. As the European Central Bank winds down its own holdings, domestic banks step in and absorb more of the new issuance. But this deepens the risk. If investors start to question a country's ability to repay, yields jump, bank portfolios take a hit, and credit tightens further. The European Central Bank's October 2025 Bank Lending Survey shows a clear pattern. Loan growth to the private sector has slowed to low single digits, and banks have tightened lending standards, pointing to higher funding costs and increased risk. In Italy and France, episodes of rating downgrades or fiscal slippage have pushed yields higher, feeding directly into higher borrowing costs for both governments and banks. Each time this cycle repeats, the real economy feels the squeeze. Investment slows, job creation stalls, and the path out of stagnation becomes even steeper. This is the modern version of the sovereign bank loop, a feedback system where financial stress can move quickly from government budgets to bank balance sheets and ultimately to families and businesses across Europe. Every day, trucks line up at the port of Dover, engines idling as paperwork piles up. Since Brexit, customs checks and regulatory barriers have become a constant hurdle for anyone moving goods between the UK and the continent. For one logistics manager in Kent, the new normal means delays that stretch from hours into days, with fresh produce and auto parts sometimes stuck at the border, losing value by the minute. Official figures show UK exports to the EU have dropped by nearly a quarter in volume since 2017, while EU imports to the UK have fallen just 5%. The cost of bureaucracy and compliance now falls heavily on small exporters, who face a maze of forms and unpredictable clearance times. Even the Windsor Framework, meant to ease trade with Northern Ireland, has left many supply chains tangled. Meanwhile, Germany, once the powerhouse of European manufacturing, is forecast to grow just 0.2% this year. Export orders are weak, and the competitiveness gap with the US and China is growing. For mid-sized German suppliers, higher input costs and uncertain demand make it harder to plan for the future. What was once a seamless single market has fractured into pockets of friction, with each new barrier adding to the sense that Europe's economic engine is sputtering. In the early 2010s, the Eurozone sovereign debt crisis exposed the dangers of a single currency without a true fiscal union. Bond spreads between countries like Italy and Germany soared past 500 basis points, fueling panic about the euro's survival. The cycle only broke in July 2012, when ECB President Mario Draghi pledged to do whatever it takes to preserve the euro. Those three words calmed markets, but they left the underlying issues largely intact. A generation earlier, Europe faced a different but equally punishing test. In the 1970s, oil embargoes sent energy prices spiraling, pushing inflation into double digits and leaving policymakers trapped between rising prices and stagnant growth. The term stagflation entered the economic vocabulary as central banks wrestled with impossible trade-offs: tighten policy and risk recession, or loosen and watch inflation spiral further. Recent events echo both eras. The spike in European bond spreads after the ECB July 2022 rate hike recalls the euro crisis, while the energy-driven inflation shock of 2022 mirrors the stagflationary spiral of the 1970s. As one historian notes, the lesson is clear. When deep structural flaws go unaddressed, crises don't just pass, they resurface, often with greater force. The warning from history is not subtle. Europe's current strains are less a surprise than a replay of old patterns waiting for a decisive break from the past. Europe's struggle with energy shocks, stubborn inflation, and political fractures is not just a regional warning. As global systems grow more intertwined, these cracks can ripple outward fast. The lesson is clear: economic fragility anywhere threatens stability everywhere. The question is, who is paying attention? Share your perspective below.